Can we say this is one of the most fascinating exits in modern media? Because if you've ever watched Cocomelon, Blippi, or Little Baby Bum, or if your kids have, you've seen the product of high-velocity content roll-up that went from 0 to 100 million in EBITDA in just under 4 years. My guest today is Alex Prokofjev, co-founder of Rollup Europe, who recently published a deep research article unpacked the full Moonbug story from the founders' bold first moves and their legal battles to the structure of the cap table and the 3 billion mega exit to Candle Media. Alex, Moonbug feels like an obvious idea, but back in 2018, what made this such a contrarian bet?
Yeah, I think Nick, if you go back to 2018, at the time, the idea that you could make a business out of rolling up YouTube channels for kids sounded very niche, and I would say even slightly unserious. But when you look at the Moonbug team, I can speculate that they saw four things. I think first one is children's content on YouTube was just taking off big time, right? It was taking off. People were watching it, and you could actually start making a lot of money through ads. Number two is all the top performing channels at the time were owned by creators, not studios. So there were a lot of individuals that built those cottage industry, and at some point they were going to exit. The third aspect was that the acquisition prices were low because, frankly, there hadn't been that many acquisitions, and Hollywood had not caught on to this bonanza. And four, and I think that needed actually a lot of experience from firms like Disney and others, which the Moonbug team had. You could actually take this IP and you could upsell it across multiple other platforms. You could take it to Netflix. You could build games. You could also build merchandise. It all seems very obvious now. The Cocomelon empire has been going strong, but I reckon if you went back to 2018, I don't think it was that obvious.
Just giving an overview first, maybe starting from the founders team, what was their background? Obviously, there were some crazy skill sets these guys had before doing all this, and maybe you giving like a short summary of Moonbug deal, and then we can go more in details of all the strategy, cap table design, execution, and all that.
Yeah, sure. So the initial lineup was 3 people. I think it's a dream team. So the CEO was René Rechtman, originally from Denmark, a senior executive at Walt Disney. And there were 2 people that joined him from Wildbrain. You may know that company. It's a Canadian business, but if you know Teletubbies, then obviously you heard about them. So John Robson was the CEO, and Alfred Chubb was the head of M&A. And I think what made that starting team very special is that not only did they come from children's content and from media business, but they were also pretty good at acquiring businesses. In fact, Wildbrain actually made its name for acquiring businesses. And what was special about the team is that they took that knowledge and they injected some velocity. So they raised $159 million of initial equity. And, from the starters, they just started doing deals. I think what was particularly helpful was that they were backed by a firm that has a reputation for media deals, which is Rain. The incentives, which I know we're going to talk about in just a second, were aligned in a very nice way as well. And and finally, they didn't wait too long for the COVID media kind of bubble to burst. They exited at a very good time, just 3.5 years in, and they turned, a couple $100 million worth of equity into a $3 billion exit.
Hey guys, quick pause to give a shout out to our sponsor, Spacebar Studios. If you're in the trenches of growing a B2B company, especially one backed by private equity, you've probably faced the challenge of generating demand without overloading your team. That's where Spacebar Studios becomes a game changer. They plug in as an on-demand growth engine for companies doing 1 to 50 million in revenue, taking full ownership of go-to-market execution. Think of messaging, outbound, paid media, and more. And their focus? Driving revenue, not vanity metrics. They've partnered with both VC and PE-backed firms across SaaS, compliance, and enterprise services, and consistently delivered pipeline that converts. If you want real growth without growing your headcount, check them out at spacebarstudios.co. That's spacebarstudios.co. All right, back to the episode. So you mentioned doing it so quickly, 3.5 years to do all this. So what were the key strategic insights that enabled Moonbug to move so quickly and effectively in a market that seemed like, if we can say, like hidden in a plain sight?
Yeah, I think there were a few things. I think the first thing was that they had a playbook from day one, how to take that IP, which at the time was mostly limited to YouTube, and how to monetize it across different channels, right? I think there were a couple of elements to this. One is systematic content production. So it's it's being able to produce more and more content in a highly consequential manner. Second, scale merchandising. So clearly, when I walk around, I see people wearing kind of Cocomelon t-shirts and hats, and that is the direct outcome of Moonbug, and obviously the global reach as well. So I think taking a channel that's just in English and translating this into French or Hindi or Portuguese has been very helpful. But most importantly, what made all of that possible was that they had the industry credibility. They saw the potential. They could also talk to the founders and sell them the dream of becoming part of a much bigger business that was just focused on that one thing, which is children's content.
So when people reaching out to me, like when I'm doing this research, and I'm sure this is the case for yourself as well, like people want numbers. So how did the team structure how did they structure their cap table and waterfall to align incentives and attract this early capital?
Yeah, sure. So the cap table is really interesting because it had multiple share classes, 6 to be very precise, and it essentially followed a waterfall where, depending on the different MOICs, and MOIC stands for the multiple of invested capital, the team would receive different percentages of the proceeds. What's really interesting is that the waterfall was revised a couple of times. So in 2018 and in 2020 it changed, and essentially the hurdle rates, there were three different ranges. So the first one was 3 times. If you were to look at it, if the investor receives less than 3 times, that there's certain percentage that's allocated, then between 3 and 4 times, and then finally the kind of highest percentage of equity was allocated to MOICs in excess of 4 times. But overall, the total amount of equity was between 20 and 30%. We calculate something like 28%. It may strike you as very outlandish and generous, obviously, given the amount of equity invested. But I would say with a high caliber team like that, with a very high deal velocity, I think the sponsor was convinced that that was the right outcome.
Now, when it comes to execution, how did Moonbug achieve 50% EBITDA margins while acquiring almost 30 brands? So what operational or financial discipline enabled that?
Yeah, I think what's really interesting about YouTube is that the cost of distribution is 0. You just upload those videos out there, and you don't have to pay any royalties because you own the IP. So that's one that definitely took out any sales and distribution expenses. Secondly, what's cool about animation, which is not necessarily the case for other forms of content, is that there are no humans involved, right? So you don't need to pay actors, you don't need to shoot on expensive locations, so it's quite easy to produce more and more of that content. And finally, the potential to sell this across different platforms and genres is oftentimes underappreciated. And what Moonbug did really well, they did licensing deals with Spotify, licensing deals with Netflix. You'll be surprised, but actually they've been making a lot of money from music. So kids want to listen to Moonbug songs also on Spotify playlist, and that's yet another source of revenue that comes at a very high margin.
Do you know how many sources of income or revenues do they collect overall, all the portfolio or all the businesses? Did you find the number maybe?
Yeah, I reckon it must be at least 10. It's a lot of sources.
So when it comes to the acquisition of Little Baby Bum, so can you walk us through the significance of this and why it was such a pivotal deal for them?
Yeah, first of all, Little Baby Bum was a really crazy business because it was born by out of essentially a bedroom in a suburb of London. It's a husband and wife kind of business, and what they did, they essentially took common property, which is nursery rhymes that people have known for a long time, and they created a brand out of them. So the input cost for them wasn't that actually expensive. And so because it was such an obvious thing to do, and because the content was so good, it grew significantly in the years up to the acquisition of Moonbug. I reckon one statistic that we found was that at the point where Moonbug swooped on a Little Baby Bum, it had achieved 17 billion views, and it was a very profitable business. This was their first major acquisition. Moonbug paid $90 million, and immediately showed the ability to turn a YouTube native brand into full-blown media brand, which then set the scene for further acquisitions.
So you said 19. It's 19 or 90?
90 is what it paid for essentially a family-owned business.
Okay. So I want more numbers. So what about the further deals like Little Baby Bum? Okay, we covered Cocomelon, Puppy. What else do you know? Because I went through the research and you have some great data there.
Yeah, absolutely. So every deal has been very, very different. I think just looking at the standalone numbers maybe isn't that kind of insightful. But if we go back to the Little Baby Bomb deal, so we estimated that that business was bought for approximately 20 plus times of EBITDA, and that's how a lot of the other deals were being done. So it may seem like a very high multiple, but don't forget that the Moonbug as a whole exited at a sort of a double-digit EBITDA multiple, and I would say, based on what we know about the space, it's very difficult to buy quality content for sub 10 times EBITDA.
Was there anything I didn't ask about the deals, maybe, which you found super interesting when it comes to the acquisitions, that strategy, and maybe executing so quickly, and maybe something post-acquisition? Maybe I didn't know what to ask.
Hey guys, quick break to tell you about today's sponsor, ScalePath. If you're a holdco or small business owner, you already know the truth. Growth comes with a lot of trial and error. ScalePath is here to help you skip some of the errors. They run tight-knit peer groups made up of 7 operators with similar business models and revenue. You meet once a month on Zoom to workshop your toughest challenges, share lessons learned, and hear about opportunities others are spotting in their industries. Whether you're in home services, B2B manufacturing, professional services, or running a holding company, there's likely a group for you. Beyond the monthly calls, members can access to expert-led sessions, a private forum, exclusive content like the members-only podcast, and even discounts to top-tier events. You can apply at joinscalepath.com, and I recommend scheduling a call with the founder, Rand Larson, to see if you're a good fit. Again, joinscalepath.com and schedule a call with their founder, Rand Larson. Now, back to the episode.
Yeah, it's a good question. I think what's very important is to always align the owners. I know that's a question that you asked me actually on a separate occasion. So if you are selling this business to somebody, like to an aggregator, what should you do? In general, I think what they did really well, we're actually talking about Moonbug, is that they did not tend to have a lot of deferred consideration. So just looking at the Little Baby Bomb deal, the owners were paid 64 million pounds, and 63 million was upfront and 2 million was actually deferred. So what Moonbug didn't do was to force them to stay for years and years, make content. I think they realized that the owners wanted to move on into other things, and they just paid them in full, took over the IP, and just cracked on with the business. In order to enable deals like that, you need to have 2 things very clearly. I think first one, you need to have a plan to transition the business, the operations, the intellectual property away from the owners as quickly as possible. And secondly, you also need to make sure that the business is not dependent on those owners. And again, children's content is amazing because you don't have those expensive actors, you don't have those locations. So it's relatively easy for you to achieve a quick, clean exit for the owners, which obviously is a competitive factor if there are multiple acquirers looking at the same asset, which wasn't the case for Moonbug at the time, but is the case for other children's brands these days.
Now, and when it comes to this exit valuation to Candle Media, 3 billion valuation, I think it's 20x revenue. Was it the IP moat, audience reach, or something else? What is your thoughts?
Yeah, I mean, it's a couple of things. It's very easy to throw stones at that type of valuation and to dismiss it as a COVID-era lunacy, as some commentators have done. I'm not a media M&A specialist, but I can definitely point out a couple of things to justify that valuation. I think the first one was that it wasn't just the earnings that Candle Media was buying. So it wasn't like a vertical market software type of business, which is not growing. You just run it as a as a bond. They were buying a media machine, which was going from strength to strength, and had a lot of potential to scale up by tapping into new sources of income. That's number one. I think number two was that they were also buying a platform that was ready to take on more acquisition. And even though Moonbug hasn't really done more deals since then, clearly it could reactivate at any given point in time, and at that point that machine could swing back into action. And the third one, well, it was 2021. I think everyone was talking about Moonbug. Everybody was watching Cocomelon cartoons at home, and in my family were watching a lot of them, obviously because of lockdown. And on the other hand, you had a deal-hungry buyer, Candle, backed by Blackstone, which had a few $1 billion in their pocket burning a hole, so they had to deploy capital fast. And when opportunities like this obviously come up, you have to act fast, which is what they did.
So was the Candle Media acquisition a signal of broader consolidation in creator-driven media, and why haven't we seen a wave of Moonbug copycats?
So we have, and there are a couple of names which I'll give you, but we just haven't seen any exits, which is why I think your question. And the names that I have seen and the people I've spoken to would be Animage for children's content. So it's a Paris-based company, been very successful in essentially replicating the Moonbug model. You have Electrify for science content, so doing a lot of content about science and history. LunarX, doing all kinds of content. And that's just in Europe. I reckon there's about a dozen YouTube aggregators around the world, but obviously none of them have achieved nowhere near the scale of Moonbug. However, there are some early signs of success. In the case of Electrify, it's a business that was set up in 2021, right around the time that Moonbug exited, and in just 3 years, they achieved a share price uptick based on UK Companies House data of 10 times. So in between the seed round and the most recent fundraise, which happened in January 2025, the price per share has gone up 10x, which I think is a measure of success.
Before talking about the founders, the outcomes, and maybe your personal lessons from doing the research, the journey wasn't without challenges. So what were some of those issues they faced during this 3.5 year period?
Yeah, I think the single biggest issue was the lawsuit right out of the gate. So we covered this in the article, but essentially what happened is that John's and Alfred's former employer sued them and sued Moonbug for essentially infringement. And the infringement had to do with the fact that allegedly, according to the text of the lawsuit, John and Alfred had first come across Little Baby Bum in their previous job, which was Wildbrain. And what's particularly fascinating for the listeners is that the full text of the court judgment is actually publicly available, so you can follow through the argument. You can also follow through what happened, but essentially it came to naught. So they were the people in question were fully exonerated. And one of the key elements of defense, which I think the judge agreed with, was that even if they had seen the Little Baby Bum idea and taken some notes, the parent company or their employer at the time, Wildbrain, was not in a good financial position, and so was not in a position to act on this acquisition. So, and I think one takeaway for the founders is obviously take measured risks. So, I would never advise anybody to infringe on anything. But this was the case where maybe if you analyze it outside in, you would have said, wow, like this lawsuit totally could have sank Moonbug, but actually it didn't. And it helped Moonbug really get the deal off the ground. So I think that was one challenge. And I think the other challenge was the fact that over time the costs have piled up quite significantly. So it's a business that, if you look at the public disclosures since they sold the business to Candle, hasn't grown that much in terms of the top line or the profits. And I think that had to do with the fact that it's been harder to make more acquisitions on a highly competitive market. I think the costs have also increased. So it's not a business that has very meaningfully increased its EBITDA since that exit. But again, it's more of a problem for the new owners and maybe less of a problem for the previous shareholders of the business.
So the team of three, how did all this played out for the founding team?
It played out very handsomely. So we made some illustrative returns. We didn't validate them with the team, but we calculate that the CEO, René, made approximately $300 million in equity upon exit. The head of M&A made 60 million, and the CFO made another 30 million, and the CEO made something similar to the CEO. And that's before the rollover, and that's before the additional incentive scheme which the new owners have put in. And we will find out when Candle eventually exit this business, whether by way of trade sale or an IPO. But I would expect that there is yet another significant value creation for the team.
So now the lessons, it's my favorite part, because we all learn various but different things from such researchers. One is you doing it, another is people listening, reading this. So when it comes to capital allocation, timing, execution, playbook, maybe what can today's rollup operators learn from Moonbug's sprint to scale? Is this replicable in non-media verticals? What is your idea?
Absolutely. I think the number one lesson, which is the most important, you need to have insight into a particular niche of the market. Which isn't to say that I'm against people that are doing industry-agnostic holdcos, but if you have a particular specialization in the niche of the market, whether it's media or HVAC or wholesale, it doesn't really matter. If you're in that market long enough, if you have enough conversations, I think you'll be able to spot an opportunity, and you'll be able to spot it before everyone else does. So that's the most important part, right? Spot the undeveloped opportunity before everyone else does. Number two is target markets which are highly fragmented, but with good unit economics. So what was good about Moonbug's business model, there were lots of smaller and maybe not so small YouTube channels which had excellent unit economics, which had very clear path to monetize those assets, whether it's advertising or something else. And so this was never a problem of buying something cheaply and then you don't know how to monetize it. No, the monetization potential was there. And the third part, if you really want to go faster, then you need to have a very good starting team. You need to have a very good operational framework and a platform that allows you to scale up those businesses, scale up that content. And, you can build this as you go along, or if you plan to raise a lot of capital, you have a very clear idea what you want to buy, it's worth investing into that platform and team from day one.
Now, they did it all very quickly. So if you can say, why is it important to know when to sell in the roll-up game, and how do you actually know when the right time is right? Because I guess there were many buyers knocking on their doors even on year 2 already.
Mm-hmm. I think 2021 was a great year because I can definitely see some parallels with winery roll-ups. So that's another recent article that we did about vintage wine estates. And 2020 to 2021, 2022 almost was this magic period when people were cooped up at home, and so consumption of certain things just went through the roof. Alcohol consumption went through the roof, but also the consumption of content. And I remember clearly from 2021 when we were living back in London, everybody was watching Cocomelon, everybody with the small kids. They were showing the kids Cocomelon in the kindergarten. And I think when you have that level of hype around that, clearly everybody will want to talk to you. And if you wait too long, I think more imitators will emerge, people wanting to take on Cocomelon, funded by the big studios. And so, yeah, I think it obviously is a very quick exit, only 3.5 years. But at the same time, I felt like the time was just right.
Okay, good stuff, Alex. Can't thank you enough for doing all this research. I know finding all the information, the numbers, the deals, structures, cap tables, it's a lot of work. So thanks a lot for doing this, and happy to do it next week again.
Always a pleasure with you, Mick.